Hello and welcome. Well, there's no shortage of topics for discussion today, but I want to focus on UK inflation with the headline Consumer Price Index hitting 7% in the 12 months to March. And we'll cover off on the broader financial markets in our investor update in a couple of weeks' time. So what messages can investors take away from the current UK inflation data? Prices are obviously going up, but not as fast as headline figures are suggesting. Let's look at the underlying UK Consumer Price Index for goods and services. In the UK, goods are the biggest share of the CPI basket, 56%. As the green line on the chart shows, they've been accelerating strongly since the lockdown period ended. Note though that goods prices did not rise during the year-long lockdown period. On the other hand, services prices, the black line, have risen steadily throughout. Once we take into consideration these lumps and bumps, the underlying inflation picture looks a bit different to the headline rate. For example, services inflation in March over March 21 was 4%. Now, the average annual figure since the start of 2020, the lockdown was 2.8%. Doing this same calculation for the larger goods segment of the CPI basket has an even starker result. The change between March 21 and 22 was 9.4% over a year ago, almost 5 times the Bank of England's inflation target. However, when smoothing out the lumpy impact of the shutdown, the average annual rate since the start of 2020 is 4.4%. It's still a high number, because there are obviously supply bottlenecks still being worked out, but it is far less headline grabbing. This next chart adds the unleaded petrol price to the left-hand side axis. And you can see that during the shutdown, prices dropped almost to £1 per litre. And that helped keep a lid on goods prices, but the subsequent hike to above £1.60 per litre has had the opposite effect. Even though petrol is less than 3% of the CPI basket, it has significant direct and indirect effects when pump prices change dramatically. So petrol and energy costs are important to the CPI measure. Indeed, energy costs will have a very big impact in the upcoming April CPI when it's released in the middle of May. There was a 54% rise in the energy price cap on April the 1st. Even though it's only 6% of CPI basket, it could increase inflation by up to 3.2% if fully passed through. Now this will drop out of the calculation in 12 months' time, but it illustrates how nervous policymakers are to ensure these one-off type of rises don't feed into expectations for annual inflation and therefore wage demands. So let's take a look at some inflation expectations. And the next chart shows UK bond market expectations alongside Bank of England forecasts. At the moment, our broader view is that inflation will fall back to more normal levels after the current supply issues tail off. The red line on this chart is the Bank of England's inflation forecast profile, with it heading back towards the 2% target from late this year. The blue line is what the bond market expects over the next 10 years on average. Our view aligns with the Bank of England. The supply interruptions impact this year and then their effects fade away. Higher prices are certainly hurting, and this will cause many households to trim spending. But household balance sheets are healthy and businesses are expanding their employment. These should keep the economy growing into next year. Inflation will rise accordingly, but should not remain at the current headline grabbing levels for much longer.